Have you heard the story about Ronald Read? He was a janitor who had $8 million in savings when he passed away in 2014. Yes, you heard that right. A janitor with $8 million. And no, he didn't win the lottery or inherit the money. He just saved consistently throughout his life, letting the magic of compounding do its work. The moral of his story is that your behavior with money is often more important than how intelligent you are. You do not need a diploma from a fancy university or a high-paying job on Wall Street to build wealth. You can get there just by developing sound financial habits. As the author Morgan Housel puts it, financial success is not a hard science. It's a soft skill, where how you behave is more important than what you know. Spend the next few minutes with the investor's brief, and you'll get a masterclass in that soft skill. This is my top 5 takeaway summary of the incredible book, The Psychology of Money, by Morgan Housel. And I am here to bring you the best tips and tools for reaching financial freedom through stock market investing. Let's dive into takeaway number 1. Pay the price. Imagine you want a new, nice watch. You head to the store to see what they have. You're looking for something that will really impress your friends and that special someone you're dating. You have a choice. You can pay for the watch, or you can try to steal it and make a run for it. I'm guessing you'd choose to pay, right? You'd pull out your card and swipe it, doing the right thing. The point is, you understand that getting something new comes with a price, a fee. Well, it's exactly the same with investing. It comes with a price too. A common theme for achieving high returns is holding a somewhat concentrated portfolio of stocks. But a concentrated portfolio has a specific characteristic. It will be volatile. This volatility is the price, the fee for high returns in the stock market over the long term. If you don't have the stomach to stay the course when your net worth drops by, say 20% in a single week, because a couple of your major holdings reported disappointing earnings, then you shouldn't aim to maximize your returns, because the higher the potential returns, the higher this fee usually is. Let's say that 10 years ago, you had the foresight to see Netflix's bright future and you invested a large portion of your money in the stock. You'd be quite wealthy today. But could you have afforded the price of that journey? During that time, Netflix experienced many major downturns. Would you have been able to hold on tight in 2011, for example, when Netflix lost tons of customers and the stock price fell 80% from its peak? Your portfolio would have looked terrible. What would you tell your family? Could you face them, knowing you might have put their future at risk? Would you still think going all in on Netflix was a good idea? This is an extreme example, of course. But even if you take a less extreme approach, you'll still have to pay the price of volatility. Let's say you simply bought an S&P 500 index fund back in 1980. Over the years, you'd still have faced about 13 years combined where your portfolio was down 20% or more from its previous high. That's the price of admission for long-term growth. Success in investing isn't just about picking the right stocks. It's about having the emotional discipline to pay the price of market swings without panicking. Treat volatility not as a fine, but as a fee for the opportunity to earn great returns over time. Investing in the stock market is one of the best ways to build wealth, but let's be real, it's not a free ride. Every single investor experiences ups and downs. Think about it. In 2008, the market plunged almost 40%. During the dot-com bust, it was down 50%. Those are tough times. But you have to see this volatility as the price you pay for a much brighter financial future. It's the ticket to the wealth creation show, and sometimes the ride gets bumpy. Now let's talk about a weird human quirk, the feeling of never enough. Imagine you get a $2 million bonus. You're ecstatic, right? Until you find out the person at the next desk got 2.1 million. Suddenly that $2 million doesn't feel so great. Capitalism is amazing at generating wealth, but it's just as good at generating envy. That drive to keep up with your friends and neighbors can be motivating, but it can also make you feel like you're constantly falling short. Let's put this in perspective. To be in the top 1% of earners in the U.S., you need to make about $500,000 a year. Let's call our top 1% guy Bill, a specialized doctor. By any normal standard, Bill is rich. He drives nice cars, takes exotic vacations, and feels pretty good about his life. That is, until he buys a vacation home in the Hamptons and realizes his neighbor is Stan. Stan is in the top 1% of the 1%, a CEO pulling in $10 million a year. Surely Stan is satisfied, right? Nope. Stan was childhood friends with Michael Jordan. Compared to Michael's $2 billion fortune, Stan's $10 million a year looks like pocket change. But it doesn't stop there. Michael Jordan goes to parties with Jeff Bezos, who is in the top 1% of the 1% of the 1% of the 1%. Bezos once increased his net worth by $75 billion in a single year. There is always a bigger fish. This constant comparison has led people to do foolish things, risking it all to move up a level, only to lose everything. At some point, you have to learn to say, enough is enough. Don't trade something you need for something you only think you want. Next up, remember that crazy is all in the eye of the beholder. People do things with money that might seem insane to you. Some spend fortunes on ridiculous things, others hide cash under the mattress. But everyone's actions make sense to them based on their unique background, experiences, and education. What seems crazy to you might be perfectly logical to someone else. Take lottery tickets. The lowest income households spend over $400 a year on them, 4 times more than the highest income group. It seems crazy, right? Especially when a third of Americans can't cover a $400 emergency. But try to see it from their perspective. They live paycheck to paycheck with little chance to save. They might not have access to education or a high-paying career. For them, a lottery ticket isn't just a piece of paper, it's a dream. It's their only shot at the life many of us take for granted. So, how does this help you as an investor? It teaches you not to just copy someone else's strategy. A billionaire is focused on staying rich. You might be focused on getting rich. Your goals are different. Understanding this helps you say no to things that don't fit your plan, like the GameStop frenzy. I'm not a trader, so I sat that one out. It simply wasn't my game to play. Finally, let's play a game of peekaboo with history. What do the Great Depression, World War II, the 2008 financial crisis, and the COVID-19 pandemic all have in common? They were massive, society-shaping events that no one saw coming. These are what the author Nassim Taleb calls black swans. They are unpredictable outliers with extreme impact that only make sense in hindsight. Imagine it's Black Monday in 1987, and the market drops nearly 25% in one day. Would you panic and sell, or would you stay the course? Here was a wild fact. If you invested in the S&P 500 20 years ago but missed the 4 best days in the market, your return would drop from 291% to just 164%. The lesson here is to prepare for disasters you can't see rather than trying to predict them. Stop listening to scary macro projections. The things that will truly rock the market are the things no one is talking about yet. And that brings me to the seduction of pessimism. If I told you the market was going to crash because of government debt, inflation, or a new virus, you'd probably be glued to the screen. Bad news just sounds smarter and more urgent than good news. But for over a century, the market has trended upwards. Progress is slow, but it's a powerful force. Setbacks are temporary, but growth tends to be permanent. Optimism is the best bet for most people because the world generally gets better over time. So stay calm, understand your own goals, and remember that patience and perspective are your greatest assets. If I told you things are probably going to get better, showing you how life expectancy is rising, sustainable energy is getting cheaper, or how computing power is exploding, you'd most likely just shrug your shoulders. We all know it, right? The pessimistic person sounds so intelligent, while the optimist comes across as naive. But why is that? Daniel Kahneman, the author of Thinking Fast and Slow, explains that this bias towards pessimism is an evolutionary trait. When we weigh them against each other, losses always loom larger than gains. Think about it. Our ancestors who treated threats as more urgent than opportunities had a much better chance of surviving and passing on their genes. This survival instinct is hardwired into us. We tend to listen to pessimists more carefully, not just for evolutionary reasons, but also because progress is slow, while setbacks are fast. Progress rarely happens overnight. It's a gradual accumulation of small improvements over decades. Setbacks, on the other hand, can happen in an instant: a market crash, a natural disaster, a sudden crisis. Because these tragedies occur over much shorter time periods, it's easier to build a compelling, dramatic story around them. And those stories grab our attention. To tell an optimistic story about the future, you have to look at longer time horizons. You have to zoom out and look at the trend lines, not the daily headlines. This often feels more vague and less exciting than a story about an impending disaster. A headline that reads, "Global poverty has been cut in half over the last 20 years," just does not have the same punch as "Stock market plummets in worst crash since 2008. The slow march of progress is a harder story to sell. Knowing this bias can help you become more balanced in your own perspective. The world is often better than you think, as the great Hans Rosling used to say. So, how can we apply this to our own lives, especially our finances? First, understand that you're not going to get rich in the stock market without paying the price of volatility. Those sudden drops, the setbacks, are the fee you pay for the long-term gains of progress. Don't let them scare you out of the market. Second, avoid envy. It's been called the worst of the 7 deadly sins for a reason. Envy makes you focus on what others have, prompting you to take foolish risks. This brings me to a crucial point. Never risk what you have and need for something you do not have and do not need. Your peace of mind and financial stability are far too valuable to gamble on a long shot just to keep up with someone else. It's also important to realize that different perspectives lead to different actions. What seems rational to a day trader is completely irrational to a long-term investor saving for retirement. Your goals, your timeline, and your risk tolerance define what's smart for you. So, instead of trying to predict the next disaster, focus on preparing yourself mentally and financially to survive them when they inevitably happen. Build an emergency fund, diversify your investments, and have a plan. And please, be careful when taking investment advice. Always understand that pessimism sells because it appeals directly to your survival instincts. An optimistic forecast might not feel as urgent or as intelligent, but over the long run, it has historically been the right bet. That's all for today. Much of this wisdom comes from the incredible Morgan Housel and his book, The Psychology of Money. I highly recommend you check it out. It's a real gem. If you want to dive deeper into human psychology and its relationship with money, here's a suggestion for what you can watch next. Thanks for watching, and don't forget to like and subscribe for more content. Cheers.